Well, hello everyone. How the hell are you?
Hi, everybody.
I am
Hey,
joined by the
KP.
illustrious Miss E Train, the star of the show.
Mm-hmm.
Good to good to see you. Hey KP, how you doing? And Melissa taking off on us. We
I
will
know,
miss
right?
you. Gotta get priorities. What is Miss Roper?
From the show, The Ropers, I think. Or
Pick emailed. I hadn't looked at the pick, so I probably need to do that for us before I say anything else. And
or it was Three's Company or something. I can't remember what show
let
it
me
was
guess, it's
exactly.
a 90s show.
Hey, KP, you're fine.
That's all right, KP. You know, it happens on a Saturday night. Sometimes it's not a great night to uh, be in a chat or a
Yeah, Three's
broadcast.
Company. Yeah, The Ropers. They were like the landlords.
Okay. So that's why I don't know what it is. In the 90s, I watched almost zero TV.
Hey, Carson.
Hello, Carson. How you doing, man? Good to see you.
Now, as many of you might have recognized, I am not in my normal environment. Um,
Is she's on the road.
I am on the road. I'm traveling. I came back up here to see my grandfather. Um, his wife is in hospice, and I think she may have another day or two. So I wanted to come up here and see him and give him some support and make sure his needs were met and that everything was good. So I am here in a very, very, very small town in the middle of nowhere, pretty much. My
KP,
internet works in the hotel and nowhere else. So
KP, Three's Company was 70s and 80s, right?
that is correct.
Okay, well, maybe I need to amend my earlier statement. In the 70s, 80s, and 90s. I did not watch TV. Sorry about that. KP, love you, Ellen.
Thank
Sending
you.
hugs. You're in my heart.
Thank you. Thank you. Thank you.
Really, she does appreciate that, as do I. It
Yeah, it's excuse me, my nose itched. Mm, my eyes hurt too.
Why do your eyes hurt?
Well, because I was going over all the family tree stuff with my grandfather today. Again, we did some last night and then some again today. And there are these, old newspapers where the print is literally like ridiculously small, and I'm blowing it up as big as I can on the screen to try to find some information. Um, and it'll wear on your eyeballs.
Just kind of overworked them a little bit.
Mm-hmm.
Well, get them rested up because you need to get started on Sherlock Holmes.
I know. Is there an audiobook? I can listen to it the whole way home,
I think there probably is, actually.
the whole 4.5 hours home.
It's I've started reading it. It's not a bad read. Um, I'm 2 or 3 chapters in, but it's only like 92 pages on Kindle.
Oh,
So
you'll be
it's
done
not,
like tonight.
yeah, it's not a Ayn Rand kind of book.
Thank God y'all did not choose that one. Whew.
It got vetoed pretty severely, actually, if I remember correctly.
I know by me.
Carson, sending hugs. My eyes hurt the other night.
It happens.
Yep.
I mean,
I didn't know
the
if there
heck,
was, like a chemical plant. I used to work next to working in pulp and a paper mill. The administration building was actually next to the plant. And occasionally that black liquor and all would get a little acidic, little acid in the air, and it'd make your eyes burn a little bit.
And Carson is doing our. Oh, I thought you were going to let me handle the chats.
Oh, sorry. Old habits
I'm
die
doing
hard.
all right. Hope you two are well. We are good. I think we are. I'm tired. I think Clay's tired. He's had to handle all three of the pups, or three of the pups, our two dogs and our cat dog, while
Which
I've been away.
the cat's been a little demanding since Ellen's been away because she's like her, her universe, her touchstone,
I'm
whatever, is
I'm
not
her
here.
I'm her doorman. That's all I am to her. She
That's
has asked for a
important to
revolving
her.
door for Christmas for 8 years, and she has been annually disappointed. So, unfortunately, she's going to keep being disappointed.
Yeah, all of them have just gotten a little dramatic and insecure without Ellen around.
So have you. It's okay.
She has taught them well.
I'm with you, Ellen. No Rand for me. I hear you. Let's. There are all kinds of reasons.
Mainly because none of her books is under 600 pages.
That doesn't hurt at all. At all.
She has a way with words.
Or help. I'm tired. I don't know. I've been doing the thing. The cat dog. She actually is a cat dog. She people laugh at us because she follows us around the neighborhood when we walk our dogs. So we have all three of them right behind us. And people go, "Is that your cat?" And we're like, "Yeah, that's Mahoney. You can say hey." And they're like,
Have you ever seen a
"It's
cat
so
walking with two
weird."
dogs?
I mean, why not? The fur babies need their mom. They do. And I'll be back soon. They got a day and a half left.
You coming?
Stop
Okay.
yawning.
I know you got me started. So KP's putting in a vote for Rand.
No, she's not. She's not. English major and attorney, not afraid of a big book. That's for sure.
How
I,
about
on the other
Dostoevsky?
hand, my ADHD is terrified of a very long.
Solzhenitsyn.
And how would I open the door now? How would I open the door for Mahoney if I'm constantly I have to get up and do that? I think that's a
KP
hard
muting
task.
KP muting her cheering for Rand. But she hasn't
Lord.
said no to Dostoevsky or Solzhenitsyn.
Like she
Just
said, she's not afraid of a big book.
something about Russians. They write big ass books. I don't know what it is, but they write big ass books.
Funny.
Speaking of funny, tonight we were going to talk about zombies. And what's a zombie? Talked about, the title of this.
Hang on. First, I want to apologize. Somehow the thumbnail totally got cut off, and that's probably because I'm out of town and probably didn't look at the exact measurements of the thumbnail that I was creating. Whoops. It's on Twitter. It's great. But I was asking Clay, I was like, what is it? Are we talking about like zombies? What do you mean the Fed is killing zombies? Like, huh? And so he had to explain it to me. So go ahead.
And she was like, YouTube is going to ban you because you're talking violence.
No, I said they're going to ban you because you wanted me to put a picture up of people shooting zombies. And I said, yeah, that's going to get an immediate strike.
I'm sorry, but the only ones that object to shooting zombies are zombies and need to be shot.
Well, I'm just saying the bottom of this was supposed to say the Fed is killing zombies and predicting the future. It just, that was epic fail. I'm a professional.
We're getting there. So what's a zombie? A zombie, I'll give you a nice broad definition here. Zombie is a business that relies on its debt. Let me rephrase that. A zombie, I was about to go into something that was a little bit more awkward. This is simpler. A zombie is an ailing business that's unable to pay down its debt and survives by just making the interest payments. So they have their operating income, which is the income before depreciation, before taxes. And that operating income is only enough to pay their operating expenses and their interest. So they've been surviving for the past few years in an extremely low interest rate environment, a historically low interest rate environment. Worked out okay for them for the previous 13 years, but the party is coming to an end.
It's over.
It's it's not over for all of them yet, but
They are the Walking
increasingly
Dead.
a number of them are going belly up. The rate hikes, I know. And I really haven't even had any scotch yet, so it's just being tongue tied. Only one I've talked to here for days has been dogs, so
You've
they don't
talked to
care
me on the
about
phone.
perfect grammar. So the rate hikes that, as we have seen over the past year, hiked by the Fed, well-known, much-loved Fed, in an effort to thwart inflation, is killing growth. It's killing expansion. It's killing jobs, or what the Fed politely refers to as reducing demand. And their rate hikes, their goal is to reduce demand, right? Which always sounds good, but what they're really trying to do is kill growth, kill expansion, and kill jobs. Now, we're beginning to see the impacts of that. We're beginning to see job openings drop. New housing construction has ground to a halt. Bankruptcies are increasing, especially in areas like commercial real estate. We have seen over the past couple of years a hollowing out of downtowns in the major cities. That impact, particularly with the addition of rate hikes, is crushing commercial real estate. Now, U.S. real estate, we've seen prices soar over the past decade. It's been fueled by the cheap interest rates. The Fed funds, when I talk about, historically cheap rates, let me throw this up. Here is history from about 1955 to current of the Fed funds effective rate, which is the rate underlying what banks charge you. And you'll see here when what was that? Volcker was trying to squash the inflation that we had experienced under Ford and Carter. He hiked the Fed funds effective rate to nearly 19%. Now, if you look at this over time, you can tell the average is probably somewhere around 3 or 4%. I didn't actually run the numbers, but just ballparking the numbers. And part of that drop is due to the nearly zero interest rates we've
For
had the past
10
10 years.
years.
Yeah. There was a little hike under Trump because the Fed was concerned about the economy growing too fast. And then COVID hit. Boom. Dropped back down to zero. So held there until inflation got into double digits. And all of a sudden, the Fed realized it was behind the 8 ball and started hiking rates quickly. So that's where we are now. And these rates, like I say, the hiking rates are designed to kill demand. Polite way to say it. The zombie issue comes in because a lot of these companies, well, there are several categories of zombies I'm going to mention tonight. A lot of the companies have, well, let me go to banks first. Most of the loans on the commercial real estate are with small regional banks. We've mentioned that before. And these rates are adjustable. They adjust every 3 to 5 years. So you've got the adjustment in interest rates coming up. You've got a rise in remote work. Studies show that employers are going to save about $11,000 per worker with remote work because they don't have to have the office space, they don't have to have the phones, they don't have to pay the utilities, all that kind of stuff. And studies also show about 65% of workers desire or want remote work, according to Global Force Analytics. Thank them for some of their surveys. 32% of employees prefer hybrid. They'll come into the office to work in a group on occasion. So it's probably something not going away. And that is encouraging what I refer to as the hollowing out of downtowns. People just don't want to have the long commute. They don't want to experience the crime and violence and the cost associated with working downtown. Now, it's estimated that about 23% of the American workforce will be remote by 2025. It saves an average of 45 minutes in commuting time, plus the other, positives that I mentioned. And there's a couple studies out showing that productivity is the same or greater. So with less office space, the increasing failure of office buildings, bankruptcy of the loan on these big office buildings, the building remains, but the owners change. Now we're seeing the consequences of people who could afford to borrow at 2.5%, but not at 7%, not at 9%.
Can you explain why that is?
Well, remember I talked about like with zombie corporations, their operating income is barely enough to pay expenses and interest. Well, the loan they had was at 3%, 3.5%. Now, when that loan matures and they have to refinance it because they don't have the money to pay it off,
I thought
that loan's at 7, 8, 9%.
I thought the bank revisited every 3 to 5 years.
On commercial real estate?
Mm-hmm.
Yeah, that's the average loan, but some of those loans were taken out 3 years ago, 5 years ago. So those are coming due.
Okay. And that's when they refinance it.
Yes.
That's typical. Unless you have all the cash to pay it off, it's typical for a corporation to refinance every 3 to 5 years. Depending upon how, okay.
In commercial real estate.
Yes.
There are other types of loans that will have different maturities. Right now, there's about 1.4 trillion in these commercial real estate loans. If I look at this chart.
Oh, by the way, real quick, Carson said he's driving, so he can't derail the train right now. He likes to get us off track.
That's okay. We don't mind. We actually enjoy when the viewers participate, have questions, throw us off track a little bit. We'll get off track a little bit. This is a chart that shows the debt in 2023, 2024, 2025 that's maturing. So most of 23 is over, had 390 billion. 24, nearly 500 billion. 25, 465 billion. So all told, for the remainder of this year and over the next year and a half, there's going to be nearly, $1.2 trillion, $1.3 trillion in loans repriced. That's pretty huge because interest rates aren't going down quick.
And people aren't making as much money because they aren't getting, especially commercial real estate, with everybody working from home, they aren't getting the rents that they need to pay for the upkeep, maintenance, etc. of those buildings. Now, before you go too far, I see there are different colors, and I know what most of them all mean, except for the CLO and CMBS, and exactly what is investor driven.
All right. The CLO, actually, we're going to talk about that a little bit. It's collateralized loan obligation.
Hmm.
And that is basically where you take junk bonds, non-investment grade bonds, and pool them in a package and then sell the package. It allows the group of bonds to receive a higher rating than they would individually.
That reminds me of the mortgage-backed securities thing, right?
Exactly.
Okay.
Exactly.
I gotta turn some light on. I'm trying not to blind y'all, but I feel like I'm in the dark. Is that any better?
No, about the same.
Really?
You're still,
God,
yep, you're still
right
just as
though.
glamorous as you were before.
Mm-hmm. I can't turn that down. Sorry.
Yeah, the breakdowns in the colors are the lenders, the source of the debt. This is the debt on commercial real estate. So you've got some of it with CLOs, securitized junk bonds. You've got mortgage-backed securities, so securitized mortgages. You've got private. You've got some government agencies. You've got insurance, national banks, regional banks. So that's the different colors on the chart.
Okay, what is the CMBS again? I think I may have stepped away when you said that.
Commercial mortgage-backed security. So it's not a
the one that
residential.
combined. Gotcha. Got it.
Yeah.
Okay. Sorry. I'm flaking out a little bit because I'm tired, so I do apologize.
That's all right.
As you see, those are
There
going to
are
go away.
there are residential mortgages. There are commercial mortgages. So
Gotcha.
these would be the commercial side. Now they're not going away. They're just getting refinanced.
But they're not. Okay, because you see, there's the amount in 2024 is bigger than 2023. What? And then
Because
2025 is lower.
yeah,
And
that's
then 2026 is none.
no 2026 is a little bit less than 25, but greater than 23.
The gray?
Are you just looking at the commercial bank portion?
No, I'm looking at the collateral loan obligation. Is that what it is? CLO? The gray.
Yeah. Well, that's just one component of commercial real estate loans.
Okay. There
What you
just
want to
aren't
look
any in
at, the
this.
only thing really you care about is this total amount right here. That's it.
See, I get into all the tiny little details, and Clay's like, it doesn't matter, Ellen. Move
Yeah,
on.
you get lost in the details.
I like the details.
I know, but there's a time and a place for details. This is not the time and the place. Get lost in the forest. Can't see the forest for the trees.
Okay, fine. So that wasn't the point. The point is
Little Miss
1.4
ADD.
trillion. Yeah, I know, right? 1.4
So
trillion
the thing
maturing.
is, this debt, all of this debt is going to need refinancing in that year. And it will
it's all going to be a
at
higher interest rate.
and it will be at 2 or 3 times, maybe 4 times what the borrowers are currently paying.
Mhm.
So you've got the higher expenses, the much higher expenses, the greatly higher expenses. You've also got the fact that vacancies are increasing or have increased in these buildings, so income is dropping. That's a bad combination. So you're seeing an increasing failure in office buildings. The building remains, but the owners change. As I believe that's Charlie Munger or Warren Buffett is.
I think that was Warren Buffett.
Indication.
It was Warren Buffett.
Yeah, we're seeing basically the consequences of people making a profit on property valued at 100 million, but now losing money on the same property valued at 50 million. They could make money at 2.5%, but not at 7% or 9%. So the effect of resetting the interest rates on the loans and the lower vacancy rates means that this is going to hit and hit hard. You know, we're already starting to see landlords walk. A few weeks ago, Ellen just sent me the other day a video of the uh, CEO of Starwood Properties. Guy's a billionaire, real estate lender. They defaulted on a $212 million office building in Atlanta. The vacancy rate was 22%, down from okay, let me put it
I think it
be
was
consistent.
90% of the people, or 90% was filled, down to 60% filled.
Yeah, what I
Is
saw
that
was 78% filled, but maybe 60
all
was the more current number.
right? Carson's got a
Question. Okay, now that I'm waiting somewhere and actually reading the title, it sounds almost like zombies are the ones killing the Fed. Wait a minute now. Fed's killing the zombies? How does that sound like zombies are killing the Fed?
the Fed rates are killing the zombies, the Walking Dead businesses that are just screwed, pretty much. Correct?
Yeah.
Did I get that
And
right?
and for our Canadian friends, Brookfield Corporation, which is kind of a Canadian version of BlackRock, just defaulted on a $161 million mortgage property in Washington, D.C. Occupancy rates were 52%. And of all the
Ouch.
cities in the country where I would expect there to be low occupancy rates, DC would not be one of them.
I can see New
Um,
York. I can see places in
Chicago,
California,
San Francisco,
Chicago,
yeah, wherever,
Detroit,
but
even.
not DC.
That's
But
surprising.
occupancy rates were 52%. The debt payment jumped to $880,000 a month in April versus $300,000 a year earlier. So I wasn't kidding about the cost doubling, tripling, quadrupling.
And we're not talking about
Westfield,
a little bit of money. We're talking about a lot of money.
yeah, Westfield just stopped. We're talking about on $1.4 trillion worth over the next year. Westfield just stopped making. That's bigger than the gross domestic output of a number of states. So that is a huge amount. Westfield, a huge mall property firm, just stopped making payments on a downtown San Francisco mall. $550 million mortgage, handing it over to the lender. Just walked in, handed in
The keys.
the mortgage, yeah, and
And
walked
there's
out.
that is a huge difference between houses or residential and commercial. With commercial, you can just hand them the keys and walk away. With residential, you can hand them the keys, but you're still on the line for the debt unless you go bankrupt.
Yep. The CEO of Starwood is a guy by the name of Barry Sternlicht. He is predicting what he calls a Cat 5 hurricane in the real estate market. Now, he points out that income is declining while the expenses are rising. Rising's not a good word. How about soaring? So, as rates rise, risk rises. Investors
Wait, Clay,
demand.
wait. Janet Yellen says there is no reason to believe that the inflation is going to continue. There's going to be any problem with the financial markets from here on out. This was like a few days ago. Are you sure, Clay?
I'm trying to think how to word this nicely. Let's put it this way. have a whole lot of respect for Janet Yellen. She has a very impressive track record for error that she
Hmm.
has accumulated over years and labored hard to maintain it. So, bless her little heart.
Do you think that,
That's
or
a
has
southern
the
by the way, those not familiar with that term, bless your little heart, that's a southern euphemism for they're full of shit.
has the Fed ever announced um, a recession, depression, called for it ahead of time, ever, that you're
The
aware of?
Fed the Fed has never predicted a recession resulting from asset bubbles they have created. I won't say ever, but in doing research on asset bubbles that they created, they've never predicted a recession. They always say all is well, all is well.
Okay, hang on. What'd you get?
I think she's talking about bless your heart.
That or
The southern
Parson Pratt?
southern euphemism.
Oh, I don't know. Let us know. I don't like to speculate on what anyone's talking about.
Now, as I mentioned, and something that is almost a constant refrain with me, risk and return are always, always, always commensurate. So, as the rates have risen, risk has risen. And what that means for investors is that they demand an even higher return, but they're currently getting lower returns. So you can expect to see more and more bail to try to cut their losses. And as more bail, that's further incentive for others on the line, on the border, to go ahead and bail. So it's kind of a herd mentality once this starts going.
And when you
So in
say,
short,
sorry, when you say the um, the buildings will stay, but the owners will change. When all this happens, this gives other people a chance to buy these properties at a very low price, even if the interest rate is high. If they can afford it, and chances are the interest rate will go down eventually if it doesn't just soar completely through the roof. Is that accurate?
well, you just have to wait and see. I hadn't gotten there yet.
Uh, I got ahead of myself, didn't I?
So in short, small banks who hold 65 to 70% of all the commercial real estate loans, small banks are about to get destroyed by defaults. They'll have to write down loans, they'll have to take a hit to capital. This means they won't be able to issue new loans. They may not even have the liquidity necessary to handle the loan defaults. That will encourage deposit runs on deposits, further crushing their liquidity and the bank's ability to remain solvent. So, this will obviously impact the economy as small banks handle most of the small business relationships, and it's small businesses that are the engine of growth in the economy. So, there'll be less hiring, there'll be fewer jobs created, there'll be less spending. Will have a negative impact on overall economic growth. So, in short, pain is coming. Pain is coming. This is what in finance we call a credit event. Um, it'll be a little bit different in nature than 2008, which was another credit event. It'll be different than this. For those of you who aren't familiar, the savings and loans crisis in the 80s. If you look at history, Volcker hiked rates rapidly in 79 and 80. And then a year or two later, savings and loans started defaulting. kind of the
I remember
same.
at one point in the 80s, like a mortgage was like 22%. It was
Yeah,
crazy.
yeah, it was. And the interest rates aren't going to get that high again, but
They can't.
you're seeing some of the same effects because expenses are increasing for banks, or they're losing deposits if they can't hike their rates, while their income is remaining relatively fixed and will increase slowly because they have, especially smaller banks, they have longer term assets that don't reprice that quick, whereas your deposits reprice daily. By reprice, I mean their interest rate on them adjust. So if I look at my savings account at the bank, it hasn't gone up 0.5% per year. Like, that encourages me to take that money out of savings and put it in a treasury bill at 5%. And that's what's hurting banks, is because a lot of people see that and are doing that, taking their money out of the banks, putting them in money markets or putting them in treasury bills. So
Um,
that takes money out of the bank.
when you hear people like the CEO of Starwood saying that this is a Cat 5 hurricane, and clearly he was in the world during 2008, do you think this is going to be worse?
I don't have any way necessarily of predicting that. It depends on, some of the responses. I do think it's going to be bad. Um, I mean, my opinion is greatly different than that of the Feds, sorta. Keep that thought.
Sort of.
But the Fed is
Okay.
officially predicting no recession. They are predicting a soft landing. If you look at their numbers and projections, they just revised them a couple weeks ago. But my appeal is simply to the track record of the Fed. They've never predicted a recession coming out of an asset bubble that they created. The low rates that they've been charging people for more than a decade fueled absolutely huge and massive rises in assets, both stocks, bonds, and real estate. So the Fed has never done well at saying, hey, y'all, we screwed up. We're trying to, return back to some sense of reality or normality here. It's going to be painful. You're going to get screwed, but it's the best we can do. You won't hear that ever from the Fed.
True.
Now,
Wait, this is not financial advice. I want to be clear, but get your money out. Did you hear that? I've lost my nubby. Where'd it go?
yeah, it is
Just realized that.
absolutely not financial advice.
There it is. Sorry. I lost my top.
Now, talking about advice, it just kind of, made me think there are several well known sites that are passing out what I would consider to be incorrect information. And here's an example of one. We've got a kind of a clip I want you to watch for a couple of minutes. And
We are
I'll
reviewing
get
this clip from a financial
yes,
perspective.
yes, just for their content and accuracy.
Can't hear it.
All right, let me start it up again. I hate how the damn thing does this.
I know you do. I'm sorry.
It's all right. It only takes a second.
And we would invite this person, their channel, to come on and discuss any of this with us or whatever.
All right, try it again. See if this works
Years at
better.
near 0%, and these low rates acted like jet fuel for the stock market. Let me explain. To truly appreciate Jeremy Grantham's comments, you first have to understand the relationship between interest rates and asset values. Asset values are just a fancy way of saying things people own because it produces income for them. Think stocks, bonds, and real estate as the most common types of assets the average investor owns in their portfolio. The value of any asset, including stocks, is based on the cash it will generate for you as the owner, discounted back to the present day using an interest rate. At first, I know this may sound super complicated, but trust me, it's actually a
Now, just one point. She says discounted back to the present day using an interest rate. That is not correct. You do use a rate if you are um, looking at cash flows from stocks. You're actually looking at something called the cost of capital or discount cost of equity. Think of it this way: you have the opportunity to invest in a brand new startup company, no track record, no cash flow. It may end up being the next Google, it may bust. Or you can invest in something like Coca Cola. Now, between those two choices, which one would you expect and demand a higher return from? The more risky one, the
Yeah.
unknown.
I was gonna
Coca
say that, but I was
Cola,
like, maybe I'm wrong. I don't
yeah, it's not a
know.
trick question. Students are always scared to answer. I'm like, it's not a trick question. Coca Cola is steady, well known. You know exactly what's going to
Safe.
happen, and
It's
and
gonna
you
yeah.
can count on it. The other company, great uncertainty. Uncertainty is risk. So the rate of return that you demand from each of those has nothing to do with the interest rate. It is the cost of capital. Equity has a cost, debt has a cost. And the cost of equity is always more expensive than the cost of debt.
Now, can you explain to me the discounted back to the present day?
Well, now we'll watch this for another few, and she shows you what she's doing. You basically are projecting future cash flows,
Mhm.
and then you want to know what's the present value of those future cash flows. Like
Okay.
the other day we asked, would you rather have $10,000 today or $10,000 10 years from now? And most people would say, I want it today, because inflation is going to erode the value of that $10,000 10 years from now.
And I'm the
It may
idiot who
only
said I want it
purchase
10 years from now.
it may only purchase $1,000 in today's goods and services. So that rate at which that $10,000 becomes the $1,000 today is the discount rate, the cost of capital. So it's just a simple mathematical equation where you
Yeah, right.
where you discount that future cash flow to where it equals present value in today's dollars.
And
Does that make
Carson,
sense?
yes. We have gotten so many copyright strikes for doing this exact same thing. We're gonna start fighting back because I am so tired of it. Mm.
All right. She's going to walk us through the present day calculation, but she keeps referring to an interest rate. It is not an interest rate. It is the cost of capital.
relatively straightforward concept. Let's say you buy a stock that produces $30 a year in cash for you every year for 10 years. At the end of the 10 years, you can then sell the stock for $300. You know how much cash the stock will be able to produce for you as the owner, but there's one last step in finding just how much that stock is worth today. You have to discount those cash flows back to the present day using an interest rate. The reason you have to discount the cash flows is because a dollar today is not worth the same as a dollar 10 years from now. Let me ask you a question to demonstrate this point. If you had to choose between receiving $10,000 today or $10,000 10 years from now, which one would you pick? Well, obviously, you would want that money today as opposed to 10 years from now. This concept is referred to in investing as the time value of money. For the sake of this example, I'm going to start out by using a 20% interest rate. Using that 20% gets us a stock price of $174 per share. To show exactly what I mean when I say lower interest rates are jet fuel to stock prices, let's see what happens when we decrease that rate. Bringing it down to 15% gives us a new stock price of $225.
Hey, Clay, can you? Yeah. Okay,
All
here's what I
she's
don't
doing.
understand.
Okay.
This is her interest rate that she's talking about discounting.
No, she's discounting these cash flows that occur 10 years in the future. You get $30 a year for 10 years.
Okay, so
So
is
she's
she at 10 years or is she at year 1 and predicting year 10?
no, she's just taking $30 a year.
Uh-huh.
And then she discounts each year, this $30, year one, back to a present value. So it might be worth $29. Then she does year two. Well, this $30 may be worth only $27.
Okay,
Year three, this
at year 10.
$30,
Wait. At year 10.
that $30 may be worth only $5 in today's dollars. So you take the present value of all these cash flows and sum them together, and you get this stock value. Okay.
No. No, it's
All
not
right.
okay.
What's
I don't understand. It's not
what
okay.
is 30? All right. If I said Coca-Cola is going to give you a $30 dividend 10 years from now,
Okay, so we're talking about today.
I'm saying Coca-Cola today is going to give you $30 10 years from now.
Every year.
How much, Ellen? Just 10 years from now. Just 1 year. $30 10 years from now.
Okay.
How much would you pay for Coca-Cola's guarantee?
Nothing.
You'd pay something because it was worth something to you.
$30? They can keep it.
In 10 years from now,
Well, 10 years from now, you're saying it's going to be worth less.
Ellen? Okay, say it's $30 million 10 years from now.
I'll take it.
How much would you pay for that promise today?
I don't know. What's it worth?
Depends on how risky you think that is. But would you be willing to pay Coca-Cola more than you would a brand new startup company for that same promise?
For 10 years from now?
Yeah.
No, I wouldn't pay the startup company because half of them go under.
Right. That's because the risk is greater.
Right.
And that risk is the equivalent of the annual return, what she calls the interest rate right here.
Right.
The risk with the unknown company, with the startup company, is much greater than the risk with Coca-Cola.
Okay. Yeah, obviously.
So you can use a lower rate with Coca-Cola to discount this cash flow.
But you were saying that an interest rate it's not a discount interest rate earlier in the last slide. Because I threw my
It's
head
not
that
an
way.
interest rate. It is a discount rate.
Okay, but that's what I was asking you to begin with. This interest rate is what she was talking about in the previous slide as I put my cursor over and you can't see what I'm talking about.
Right.
Is that correct?
What are you asking?
Okay, the little yellow box, the little first thing on it says interest rate.
Yes.
She's using an interest rate. Is that
It's the
what she
wrong
was
term. It's
referring
not
to
an interest rate.
Thank you.
It's a discount rate.
Okay. And it discounts the money from the future or the present?
Hold on.
Sorry, y'all. I'm getting my own little lesson here.
I'm using my touch screen. Here is the magic. This is the formula. This is a discrete version of the formula that she's talking about. So I've got a present value here, which is what I would pay for a future value discounted at this rate over this amount of time. So in her example, 10 years from now, a $30 figure. Future value would be 30. Time would be 10. And the rate would be whatever rate she's using. So that gives me the present value. This is called discounting because I'm discounting a future cash flow back to the present.
See, you could have just said that in the beginning. Yes.
Well, you tell me to stay away from math.
No, not that kind of math. It's just when you go like in the weeds math, there's a difference.
Okay.
Weeds math and normal math.
Anybody have any question about this? This okay?
I mean, am I the only person who does not understand what the hell he was talking about? Or, well, there's 3 of us, so I guess that was just me. All right. So
she's taking that and applying that formula to each one of these cash flows.
Okay.
And then she takes the present value for each, sums them up, and gets this value, this stock value.
And she's assuming that discount value is 15% for each year?
Right.
Or
each year.
Okay. But it could be variable.
It actually could vary year by year. And this rate is actually a function of the risk of the stock, the risk of the company, the liquidity of the company, the reliability of the cash flows. So for a small, uncertain company, you're going to use a higher rate. For a well-known, guaranteed, very safe cash flow, you use a lower rate. That's why the debt on Treasury bonds is less than on a corporate bond, because the government bonds are considered risk-free because the government's going to pay you. They own the printing presses. They can always pay you. Yes, ma'am.
I feel like there should be a whole nother line underneath total cash flow. Because if you're
Yeah, I would do it with several lines under showing each discounted value and then summing them up.
Then if you're getting $30 a year and I get the 330, but then sum out the whole thing. And what did you invest in the first place? Like there's a lot missing in this.
Well, this is just a simple demonstration showing discounting future cash flows. The point is, this is not an interest rate. This has nothing to do with interest rates. This is wholly separate from an interest rate. If a company has no debt, interest rates don't especially impact them. Now, interest rates indirectly impact the economy.
But this is not an interest rate. This is a formula.
This is a discount rate.
Separate.
Okay. So my issue with this is they are tying specifically interest rates, the Fed's interest rates, to stock values. And that's incorrect. It wasn't the low rates that caused the stock market to balloon. And we'll look at that in a minute.
Wait, it was low rates,
Ellen?
wasn't it? Okay.
Ellen? Miss Ellen.
All right, Carson, this is to figure out how much it's worth to invest. But how do I know how much they put in there and to get that
Ellen.
$30? Okay.
Ellen.
I'm gonna go make a drink. Y'all have fun. I'll be right back.
We bring
All
it
right,
down
let's catch the
further
rest
to
of this.
10%. The stock price continues to soar, all the way to $300. If we bring it down to 6%, the stock continues to skyrocket, with the price hitting $388 per share. Notice how the amount of cash the stock produces stays exactly the same. The only thing that changed was the interest rate. The declining interest rate was powerful enough to push our stock price from $174 a share at a 20% rate all the way to $388 per share at a 6% rate.
Again, these are discount rates. The 6% would apply to a company like Coca-Cola. The 20% would apply to a company that's unknown, new, startup, has no real guarantee of ever making the cash flows. So you would be willing for the same commitment from the startup company versus Coca-Cola, you would only be willing to invest less in the startup because there is greater risk associated with the promises of the startup. More unknown. Unknown is risk.
Can I ask another
But
question?
none of that has anything to do with the Federal Reserve's interest rates.
Can I?
Do what?
Hello. So why do people put so much? Oh, is it off? Can y'all not hear me?
Yeah, you're on.
Oh, okay. I think this is Elaine, your mic. Elaine, I know that reference. So why do angel investors put so much money into startups?
Because the rates of return can be very high. The risk is very high. If you do venture capital or angel investing, you may invest in 10 different startup firms. Out of those, 6 or 7 you'll never see a dime from. 1 or 2 you might see some cash from. They may even break even. But your real hope or expectation is that 1 out of the 10 will be a home run. And the returns, the gain on that 1 out of 10 will cover the others 8 or 9 losses.
Gotcha.
So it's looking for that home run ball. It's hoping you put in $1 million and you get 10% of Apple, and in 10 years, it's worth $1 billion. So that is the deal. That is not related to interest rates. Now, like I say, interest rates have an overall impact on the economy. And if you'll notice, the Fed's been hiking rates for a year, and the economy is just now starting to react. It takes a significant amount of time for the Fed's policy changes to take effect, to show the results or the fruits. But this demonstration, calling it interest rates, is misleading at best.
This is an increase in the value of the stock of a whopping 123%, all of which the stock didn't even make a single additional dollar of cash flow. Now you can see why low interest rates can push stock prices to mind-boggling levels.
See, and that's what I disagree with, because we have seen times where decreasing rates have resulted in lower stock prices. We've seen times where increasing rates have seen the stock market rise. So there is a very weak correlation between the stock market and the Federal Reserve interest rates.
Sorry, Catherine, you're not supposed to tell anyone that Runkle is on right now. Just saying.
You need to be on Runkle telling everybody that they should be watching Moffat.
Exactly. Not the other way around.
That's all right, Catherine. We're glad to have you. Appreciate you coming.
Hey, wait a minute. No, you
swear to Zora.
say his dog Yeah, you better
Uh,
Runkle's dog. You, Carson, you just go over there and say, "Hey, I'm over on Moffat on Money. Come learn something."
yeah, I will admit mine is not. I don't know who Maya is, but I'll assume
I
it's
don't either.
something interesting.
You could go watch Maya and find out.
Mine is not as I'll say entertaining,
I don't
but
know.
5 or 10 years from now, I think you'll appreciate the information here
You'll be
a
a
whole
lot
lot
better
more
off.
than Meyer. Yeah.
Maya and Runkle. Yeah. We love Runkle. We
Um,
want Runkle back. But yeah.
yep. Not knocking Runkle. And I'll agree. There are some things within the law in some cases that are just fun. It's almost like passing a big bloody car wreck. You got to slow down and listen and watch. And some of this is not terribly exciting. Freely admit that. I love it, but
Thank you, Carson.
I understand that that at times communicating it, particularly over YouTube, is not that dramatic. But I do believe it's valuable. The key to understanding all this is context. We had enormous spending via COVID relief and increases in other government spending. And we had resultant inflation due to the amount of spending and the money produced. The Fed printed over 4.5 trillion in 2 years, which kicked off inflation. Catherine, she is suing John Hopkins and the insurance company. It's a sad case. She has a chronic pain condition. Also watching my 4-year-old feeding carrot tops to the rabbits.
Oh, the bunnies.
The bunnies.
Wait,
We
they're
might
not
need
meat bunnies, are they? Don't get attached to the bunnies. Anyway,
so
continue
the
on.
Fed printing money, the Fed hiking rates quickly is due to inflation. And inflation is still a problem. It's even risen the last couple of months. Probably Tuesday, I'll have some videos on. There's a lady that actually went back through her records. She uses one of these grocery delivery services. I forget the name of it. But she went back 2 years ago and found out how much she was spending on groceries every month. And then how much she's spending on groceries now. It's kind of an interesting video. You remember a couple of weeks ago, I said, the official inflation rate for food over the past year is, what was it, 12.6%, something like that. I forget the exact number. And I'm like, oh, hell no, because my costs have easily doubled.
Oh, yeah.
Because, I know what I buy when I go in for a week. I get, 4, 5, 6 grocery bags. I know what they cost. I know what they cost now. I haven't changed my eating per se.
Oh, I went just to the grocery store last night for my grandfather. He needed 2 boxes of cereal, some chocolate milk, um, some cough drops, a few bananas, and some sweet tea. Now I got like a little 6-pack of Fresca and a couple of Monsters. It was $42.
Yeah.
That's crazy.
Yep. And, like I say, inflation is still a problem. Everybody's excited because the rate has come down. Well, let's be perfectly clear. The rate is still just saw that. The rate is still
Oh,
double what the Fed wants. And it, like I say, it's increased the last couple of months.
hey, wait,
Y'all know
we have a Canadian that just said y'all.
he's obviously from the south of Canada.
Yeah, it is expensive. Every freaking thing.
It is. It's, before long I'll be moving to some place and doing a little homesteading, actually. Be raising some of my own. The So Jay Powell, the Fed, hiking rates, he keeps saying and telling people, the rates are going to be higher for longer, higher for longer. Why? Because they've not yet crushed demand. And what do I mean when I say demand? I mean your ability to buy stuff. So, you know, if you can still afford stuff, don't give up hope yet. It's going to get worse. So we've seen the markets rise as rates have risen. We've seen them fall as rates fall, which is a problem that I have with that, little video I showed you. She seems to state that interest rates are highly correlated to market returns. They're actually not. If I look, let me get this up. If I look at this chart, this is from Morgan Stanley, and they actually plotted the correlation between interest rates using the 2-year Treasury and movements in stock returns. And if you'll notice, this is a 0.4% positive. This is, 40% negative. A positive correlation means that both the yields and stock prices move up together 40% of the time or 40% of the degree. Negative correlation means they move inversely. One goes up, the other goes down. So if 40, most of the observations here, most of the years fall between 40% positive correlation, 40% negative correlation. The average is, less than that. The idea is there's not a terribly strong correlation with absolute movements in interest rates and direction of the market. Here, if you look at their little summary, you can see change in Fed funds. In this period, it was 3%. This period, it was 1.75. 15 through 17, it was 0.75. And then you look at the total market reaction. And it's not consistent. Here with the lowest movement in interest rates, you have the highest movement in the stocks. And remember, I said earlier that interest rates weren't the primary mover of the market over the past 10, 13 years. They weren't. It was how the Fed kept rates so low. The Fed didn't just change the Fed funds rate, which is their normal mode of adjusting interest rates. It eventually filters down through the banks and causes rates to rise. The Fed actively intervened in the market, spending trillions of dollars, buying agency bonds, buying mortgage-backed securities. There'd be some months the Federal Reserve would buy over 100% of mortgage-backed production. That's not a mild intervention. That is owning the market. That's forcing the market to their will because they had unlimited money to print. They could buy anything they wanted. Their balance sheet ballooned from virtually zero to over $11 trillion. So buying assets, you buy bonds. Remember, interest rates go down, price goes up, supply and demand. You're demanding more bonds, so price goes up, the interest rate goes down. It's how they got the rates down that was key. It's the manner in which they did it. That kind of cash being spent in the market gave banks tons of cash to spend. Well, they weren't making loans a lot of times, so the only place they could take that money that they got from the Fed would be invested in the market. And they did. And so the stock market took off. So that's why I say it wasn't the Federal Reserve's low rates that caused the market bubble. It was the Fed's active intervention in the markets, something, in my opinion, they should never do. So if we look at, this chart and other charts, then there is no clear, definite correlation between a hike in rates or a drop in rates and movement in the market. Yes, ma'am.
Catherine had a comment, and I'm not sure.
So the prices haven't come down, but the increases are going down.
What does that mean?
On groceries? Are we talking about inflation rate? Yeah, that was my point earlier, is that people are celebrating because the rate is quote unquote down. Well, all that means is that things aren't increasing as fast as they were. They're still double the Fed's target. So inflation is still high. Inflation is still ongoing. It's just not as bad as it was. Flip side is the last 2 months, it has gone up. So we are not done with it yet. So we've seen the markets rise if rates rise. We've seen it fall as rates fall. Probably likely to see it again when we fully enter a recession. Because think about it. Once the economy starts dying, what does the Fed do? Well, it starts lowering rates. Well, the stock market, what does it do when a full-blown recession begins? It drops.
Well,
yeah,
I think
it
we're right
drops.
before a recession, and they've been raising them, which is really weird.
Okay. In a recession, rates drop. In a
Yeah.
recession, the stock market drops. So that blows that whole explanation we just watched out of the water.
Out of the water.
It's not an accurate representation of what actually has occurred or does occur. And it's, if you're an investor, it could be very misleading if you're trying to make decisions based on poor information.
Yeah.
So that,
way too soon to celebrate. That's true, Catherine. Thank you for clarifying. I just think that so many people, I mean, Warren Buffett and the guy that owns as a CEO of Starwood, and Jeremy, help me. What's his name?
Grantham
are all saying, yeah, this is going to be worse than 2008. This is going to be a terrible recession. This is not over. This is not anywhere near over. I think Grantham was predicting the end of 2023 through the first half of 2024 was going to be the worst. I don't know.
Yeah, I don't give definite crystal balls because there's just a lot of variability in there, but I do pay attention to the trends, and the trends are starting to pick up, and they're not good. So a lot of significant events are occurring that get very little press, and that's kind of one thing I guess I'm proud of this channel for, is that we do get you better information to make decisions. For example, Airbnb is going bust. Bookings have dropped. Host revenue is down about 13%, and it's only really just begun. In several cities like New York, Chicago, San Francisco, my 3 favorite cities to pick on, they're waging a war on Airbnbs, blaming them for their policies, which are choking housing for their residents. It's in my opinion, just tantamount to a war on the middle class and the cutting out sources of income for them. You're looking at thousands and thousands of people who took out mortgages, some using their retirement savings to buy houses that they couldn't afford if rates rose or rents dropped. And both of these phenomena are occurring via the Fed's demands. Ultimately, this should encourage further drops in housing prices, which will in turn encourage higher default rates. People, when they see their mortgages are underwater, they are less likely to continue to want to pay them. It's history. So this will continue to put more and more pressure on small banks and lenders. Yes, ma'am.
So I have kind of a out there question that just my curiosity. The United States just sent 128 million, is it million, over to Ukraine.
Yes.
Before that, my calculations, and I know they were under calculated, was 77 million per day since the Russia invasion that the United States has sent to Ukraine. Correct?
Okay.
So we're borrowing money from China to send to the Ukraine. How is that affecting inflation here? Or is it?
We talked about last week how China and Japan are actually selling tons of their debt, US debt. Those two countries for the longest time have been the largest buyers, purchasers, international purchasers of US debt. China had up to is roughly 1.5 trillion of US debt. They're now down to about 800 trillion and continuing to dump it. So neither one of those is buying US debt right now. They're
Who
dumping it.
is?
Well, that's a good question. That's one reason why rates are going up and why rates will stay up and go even higher, because the US government is borrowing tons more money. Keep in mind, the national deficit in 2019 was 469 billion. This year, it's going to blow past $1 trillion. Next year, 1.5 trillion. So and we talked, was it Tuesday night? Not only is the US issuing more new debt, we've got old debt coming due that needs refinancing. And over the next year, we'll have 7.9 trillion in debt that needs refinancing that matures. So all told, we'll be financing next year about 10 to 11 trillion dollars in debt. And we'll be doing
And
it at rates that are far higher.
I was going to say the rate's going to be higher, and we can't afford to pay that either.
Yeah, the
I mean,
rate's going to be, the rates are easily going to be 3 times higher. And so
what does
interest
that mean?
expense is blowing up. It means we are getting deeper and deeper debt. Interest expense is blowing up. This, I don't know if it'll make it this year, but it'll be close. Interest expense will pass before long our total defense spending. In another year, interest expense will pass what we spend on Social Security. And shortly thereafter, it'll pass what we spend on Medicare, Medicaid. So
I have heard that even people not much, younger than you are not going to have their Social Security if this trend continues. The way that we're spending money all over the world, people don't want our debt anymore. To be honest, I mean, if China and Japan aren't buying it, then who is?
yeah, there's nobody stepping up to fill their vacuum. That's a big
Even though,
problem.
and we pay for everything all over the world. We've always sent aid. We've always sent everything. In Ukraine, we just keep throwing money at something that they're never going to win. In my opinion. Sorry, I got you off track.
No, that's all right. We just had a 20-year auction a couple of weeks ago, and it was a relatively poor auction. Yields had to increase 10 basis points, which is, if you do anything with bonds or fixed income, is a huge jump for an auction. That's a bad sign for future auctions, that the market is demanding higher and higher rates because there are fewer and fewer people buying it. So, people that think rates are going to drop soon and drop significantly, well, they're just not thinking.
They're telling you what
Again,
you want to hear.
yeah, again, there are trends going on in this world that just you can't ignore. So you've got bad news for Airbnbs, housing. And think about it,
Commercial
in
real
your
estate.
neighborhood, in your neighborhood or region, if there are a couple of Airbnb houses, and I'm talking about, somewhere in the 10, 20 square block region, if those houses go on the market, the owners have to dump them because they're about to go bankrupt. Then the bank takes them over. The bank sells them short. The bank doesn't care what price they get because they just want to get rid of them. They're not in the home maintenance business. They don't want all the associated expenses and liability. The longer a home sits empty, the more subject it is to vandalism and destruction and decay. So banks want to get rid of it, and they will sell it at a very low price just to dump it because they don't care. They don't hold the loan. They don't take the loss. Whoever they sold the loan to, the mortgage-backed security holder, takes the loan, takes the loss. So they'll sell that house for 80% of its value, 60% of its value, and they don't care. But if you
And
start
that's
having a
office
couple,
building, commercial or residential, either way, right?
yeah, they're going to be lucky to get 50 cents on the dollar because nobody is going to pay 120 million for that building, not with 60% occupancy. It's worth half that. And that's if you can keep the 60% occupancy, which, as some of these leases expire, companies aren't renewing the leases. They can get cheaper rent. A lot of their people are staying home. They don't need all the space. Their people don't want the commute. They don't want to work in the downtown areas that are increasingly violent where their cars get broken into. They don't want the expense of having to eat downtown. There's just a number of repercussions out there. So if, houses within a few blocks of you sell for 70%, let's say, of their market value, when you try to put your house on the market, well, that's going to go into the comps. That's going to lower your price, and it'll lower what people are willing to pay. So
Yeah,
sooner or later,
I've heard of something
yes.
called the golden handcuffs at this point. Those who bought their houses at low interest rate are sort of handcuffed to, they don't want to move because interest rate is so excuse me, high elsewhere if they went and bought another house. And chances are the real estate value is going to plummet, at least some. I mean, it's been so overinflated recently, just like everything else. True.
Yeah, but my thought is that that's kind of killing, supply right now, and is one reason why existing homes haven't dropped too much. Now, new homes have dropped a bunch. Unoccupied homes have dropped a bunch, but existing homes just aren't going on the market. However, given enough time, people still ultimately need more space, or they get a job elsewhere, or they lose their job. They can't afford their mortgage. Number of reasons. So I believe that's a temporary condition that sooner or later people are going to have to start, putting their existing house up for sale. And it'll be at a whole lot lower price than what they thought they were going to get. So that's a problem. If you look at debt levels for individuals, those are skyrocketing too. Household debt just blew past $17 trillion and is expected to continue to rise. If I look at that, I think people are using debt to try to mute the effects of inflation for as long as they can. They're putting more and more on their credit cards to try to make ends meet. To buy groceries, whatever. Applications for credit are up nearly 25%. rejections are rising as well because banks are, seeing the same numbers, getting the same information. They're thinking that people are borrowing more and more and with less and less likelihood and ability to pay them back. So if you look at it that way, then you would have to say that low and middle class mortgage holders are becoming zombies. They're racking up credit card debt
Yeah.
that they can't afford ultimately. And as interest rates continue to rise, as their interest expense continues to rise, as the cost of goods continue to rise, they are becoming de facto zombies. So we've talked about banks kind of becoming zombies. We've talked about, I guess, individuals kind of becoming zombies. Now corporations,
Real quick, before you go there, we talked about banks becoming zombies, but not international banks, not the big, huge banks, because they don't have that
looking
much
at
commercial debt.
small regional banks,
Okay. Just want to
which are
clarify.
kind of the lifeblood of the economy because they're the ones that deal with the small businesses and make the small business loans. So if there's fewer and fewer of them, if they have less and less liquidity, if they are being bought out by the bigger ones, then that's really going to hurt small business lending.
Which
It's
is
gonna
going
hurt.
to hurt mom and pop shops, mom and,
It's going to hurt commercial real estate development. So
and it's going
the
to bolster
long
the power.
term,
Go ahead.
the long term effects are, I mean, you're looking at killing a good portion of future economic growth.
And it's going to bolster the big banks and their power and ability
Yes,
to
they'll
kind
become
of
even
control
bigger.
who gets the loans. Yeah.
Back in the subprime crisis, there was the cry or the chant, too big to fail, too big to fail. Well, since that time, they've only gotten bigger.
Yep.
So, and we have forces in the economy, in the marketplace to make them yet bigger still. So, is that a risk? Is that a big risk? I think increasingly so. Other things going on? Bankruptcies. In July, there were 9 major corporate bankruptcies. August, there was 29 zombies. Delinquency rates on credit cards are rising, as well as on car loans. Individuals are starting to face very difficult, very challenging situations. Over the next year, 350 billion in junk bonds mature, with another 810 billion in 24. So companies' interest cost on refinancing those bonds will double or triple. Some who financed at 3% will now be paying 10 or 12%. That's a huge, huge shock to profits, even
And
the
like you said,
ability to pay.
like you said earlier, it goes from $300,000 a month to $800,000 a month or more.
Yeah. In this case, it'll go from $300,000 a month to $1 million a month.
That's tough.
We're seeing an increase in strikes. It's some people are kind of entertained, I guess. Currently the UAW strike is ongoing, isn't likely to be resolved soon. And I find it interesting. The UAW is demanding a 40% wage increase. And when I first heard that, I thought, where the hell did they get that number from? Well, they got it because they say that's the rate that the auto companies' CEOs' pay has increased the last 5 years. And I'm like, that
Okay.
is kind of a point. Flip side is that increase in the CEO's pay adds a dime to the cost of a car. I don't know, but it's insignificant. Whereas if you pay the factory workers, give them a 40% increase in pay, you're going to see car prices jump. Not sure how much, but I saw
There's a
one
lot
guy
fewer
estimate that,
CEOs.
yeah. And, for a company like General Motors, paying an additional $20 million to the CEO doesn't really change the balance of things.
Yeah, but 20 million
So
to the little people would make a big difference, though.
GM has how many workers? I got to look this up here real quick.
He loves to challenge me on what I'm
No,
thinking, saying. Um,
GM
and
has
when cars,
approximately 167,000 employees. So if we took 20 million,
divided it.
that would give each worker about $120 a year.
Well, shit. Okay. Well, it's a little extra.
It's a little extra, but I doubt the UAW is going to appreciate that. GM says,
Yeah.
okay, we gave 20 million more to our CEO. We'll give the workers 20 million. And how's that? Practical reality. Workers have a point. The unions have a point. Flip side is they may end up killing their own company if they get it.
Yeah.
Fewer and fewer people buy cars. If fewer people buy cars, GM's going to have to shut down plants. I mean, we saw the same thing with steel workers in the 70s. The unions kept demanding outrageous increases. And so all the U.S. steel production went overseas. And all the steel mills were shut down. I lived in Birmingham. I grew up in Birmingham. I saw it firsthand. Absolutely devastated the city and particularly the areas with the steel mills. Catherine, automation is a far bigger problem for the workforce. That's going to be a huge cost savings for the company. Exactly. The more and more wages rise, I mean, hell, even McDonald's is going to kiosk, instead of somebody at the front asking, may I help you? There's practical realities in this world. So I don't know how that's going to work, but we are seeing an increase in strikes. You are going to see higher wages. You're going to see higher prices on goods. Oh, what does that mean? Inflation, even more inflation. You're going to see slashed profits for the automakers as they have to start shutting down plants. So they'll sell fewer cars. They'll have to shut down plants, lay off workers. This will greatly impact suppliers and dealers as well.
Where are the biggest manufacturers now? And Detroit was like no one was there. Are they still there? The plants from
I don't know the exact composition. They're all over the country. But I don't know the exact composition or location of GM's, Fords, and what's the other company that bought them out? Strehler. This used to be Chrysler.
I don't know. Chrysler's not Chrysler anymore. I had no idea.
No.
Because it was Jeep, Dodge, Chrysler, or they're the same, I think.
Yeah.
I don't know.
So basically, you're going to see lower production, workers get laid off, higher wages. How cool is that? Does that sound like a vibrant economy to you?
Nope.
Funding is also drying up for new growth for small businesses. We talked about CLOs earlier, collateralized loan obligations. It's just a bundle of junk bonds, bonds of weak companies, which is repackaged as a bond, as a single bond. Nobody wants junk at hardly any price right now. This, even though interest rates are at the highest point they've been since 2009, 13 years. one thing that a lot of people overlook is that all of this is a problem for equity investors. Stocks in these companies, zombie companies, returned an average of 15% in 2022, which is not a bad return considering the risk. Now, with the income being soaked up by interest cost, higher interest cost, returns are near zero or negative. So the loans that are collateralized by stocks, like a company sometimes will put up its stock as collateral for a loan with a bank. Well, once that stock price starts getting hammered, that bank's going to call that loan. And then what? The company's ability to raise capital at that point is nil.
Everybody
what
who's
happens-
leveraged their stocks
Exactly.
are going to be called in, or they're going to ask for more money, which they probably don't have cash on hand, is my guess.
And another thing is that this doesn't just affect zombies. Think about it this way. Quote me on this if you want to, but zombieism is contagious. Capital for investment grade companies is forced, those companies are being forced to pay up as well. There's about 550 to 750 billion per year that matures on average every year. And the rates on that are soaring. For example, Amazon in February had 2.4% bonds mature, about $1 billion, and had to refinance it at just under 5%. Now it'd be closer to 6%. High grade, investment grade bonds are the highest levels again since 2009. These companies' interest cost will double or triple as well, again, forcing higher cost and killing expansion or growth, causing higher prices in goods. So what we're seeing right now basically are the fruits of having interest rates too low for too long, manipulated rates for too long. Now we're seeing Jay Powell, the chairman of the Federal Reserve, chant higher for longer, trying to get it through people's skulls that this is not going to be a short-term aberration. And speaking of higher interest rates, they are the new normal. The patient, the U.S. economy, is sick, even though it hasn't manifested itself necessarily to the common eye. The problem is that the medicine prescribed will only trade off one sickness and misery for another. There just is not a good, simple answer to the mess we're in. So if you doubt me, and that's okay, I don't mind. If you doubt me, now you may point to the Fed's prediction. We already talked about that. But I would look more at what some of the governors say, kind of off the record. And one of the Fed governors, Bostic, who is the president of the Atlanta Fed, the Atlanta Regional, said at a conference in South Africa, we have, quote, and I quote, we have a lot of existing debt out there, so it's at very low prices. When that comes due, they're not going to be able to refinance into comparable prices. There's going to be an adjustment that needs to happen on that. So I actually think there's a shaking out that's about to happen at all levels. Here's a Fed governor saying there's going to be a shaking out at all levels. He's saying something is coming which will push corporate debt over the ledge. In finance, we call that a credit event. Okay. So I'm pretty convinced that something major is about to happen, and there will be a recession, and it will not be a short, easy one necessarily. The stock market will fall. Now, that's not a bad thing. It actually is normal. Historically, it happens every 7 to 10 years, falls 20%. And I have mentioned repeatedly on this broadcast about keeping your powder dry. Right now, you can earn 5% in a money market, which is not horrible, but it gives you flexibility that when the time comes, when the opportunity presents itself, that you can take advantage of it. The market historically drops an average of about 32% during major recessions. Obviously, mild recessions are less, but with a major credit event occurring, the chances are it will be mild or slim.
Hang on. All right. This is not financial advice. Disclaimer. We are not suggesting that you do anything. We may be saying that some
Just
people
giving my opinion.
may want to pull out now and invest later when prices are low. But not advice. Not advice.
Yeah, not offering anybody specific investment advice. As per usual, I am just giving my opinion and thoughts on the matter. So when this happens, if this happens, it will be one of the best opportunities you have during your lifetime to buy. Keep in mind, the S&P's already dropped 6% from its summer highs, and we are just starting to get the news and see some of the trends occurring. Second thing is that interest rates will likely rise a little more, but we are probably close to the top. After that, they will fall when the recession gets underway. If you're scared of stocks, you can invest in bonds, even in treasury bonds. Remember the teeter-totter. As rates fall, prices rise. So there is opportunity in bonds to improve your yield due to these higher yields and prices rising. Yes, ma'am.
What is in your hand?
A little piece of plastic.
Oh, I'm like, what are you waving around there?
I don't have a marker to throw at anybody.
Well, it's just me and Catherine, so I think you're good.
So if you're conservative, you can take advantage of some of the opportunities in bonds. Now, you won't be able to buy bonds and hold them to maturity because you will lose that gain in price as it gets near to maturity. So you'll have to be willing to sell it. Buy it, hold a few months, yields drop, sell it, capture that gain. You can reinvest it for the same cash flow. But with the 30-year bond, for example, if rates drop from 4.5% to 3.75, your bond will be worth roughly about 105, 106% of what you paid for it. Catherine, you saving that for the recycle bin? Well, it isn't worn out yet. I'm still using it. It's still good.
He likes to chew on them.
Yeah, I'll chew on them. I
know
try
what to
not
tell
to
ya.
chew on them while I'm in
On screen.
on video. Yeah. So you've got the 4% yield. You've got an additional 5.5%, 6% gain on the price. So that gives you a roughly 9 to 10% return. So if you're a very conservative investor, that's a decent opportunity. Now, again, I don't recommend individuals trying to buy individual stocks unless you're familiar with the company and you have good information, including on when to sell it. It's riskier for individuals to buy one company or two companies or have a small portfolio. It's also more expensive. And the main problem with individuals is not so much picking out a good stock to buy, it's knowing when to sell. So I generally recommend no-load mutual funds. Now, as you're saving up and wondering, how to do this or, about funds, I've got a video on beginning investing that will
I
be
haven't
out
gotten up yet.
sometime soon.
Sorry,
I'm not going to say it's coming out soon.
Is dying, and
I'm not saying
We've
it's
had a
coming
few
out
things
soon,
going on.
but it
It
is
only
coming out sometime.
it only took you 4 months to get it out to make
So
it.
no, it took me a month to do 4 different takes to make it.
I think it was a little longer than that. I'm just saying.
Um,
So
but
it can
anyway,
take me a few weeks to get it together.
that will give you some good guidelines on how to, how I recommend most individuals handle beginning, investing, even if you've only got $50 a month. As you're saving up, you do want to be thinking about industries or areas of the economy that will do well after the dust settles. If you're not sure, you can always buy an index like the S&P 500, mutual funds that invest only in the S&P, that mimic the S&P 500. They oftentimes tend to outperform most mutual funds, so that's always a pretty good solid choice. Again, that beginning investing video will give you some information. And if you try to buy in a recession, understand you won't buy at the absolute bottom. Thank you, Catherine. I appreciate that. I got to
Listen,
do
he
some
was
more
there.
shorts.
He does, and he was like, "It sucks. I'll do it again." I'm like, "Just leave it. It's your first time." And I said, "Look, you're cute. It's fine." And he said his video has gotten more views than Chunk on that video. I said, "I told you were cute."
And I'm thinking Chunks ought to be. I still go back and watch Chunks on occasion. I think that is just cute as hell.
Well, he
But
was
buying in a
talkative.
recession, if you start buying when the market's down, let's say, the recession hits, markets start dropping. Say you start buying when it's 20% down, and then it goes to 25% down, and then maybe 30% down. All of that is good. You'll be extremely glad long term, a few years from now. So you want to be saving now so that you have some cash in the future. And don't worry about precise timing. Good timing is when the market's down. Catherine, they are fun coming from your car. It's kind of like you're in a casual sort of guy.
He is. Catherine, he gets in trouble for going to class in his flip flops and kicking them off and walking around the class barefoot in a t-shirt and shorts. I mean, he is such a casual guy. Don't let
Well,
all this books and stuff behind him throw you off.
the problem is one of the rooms I teach in is a big glass room, and it's got like colorful stock tickers and a couple big boards with stock prices and all on it. Kind of mimics the New York Stock Exchange. And the chancellor will bring like the trustees through there. And so I'm in there in the middle of the room, barefoot, waving at the chancellor in front of the board of trustees. They might expect a little bit more formal or a little bit more decorum. But the weird thing is, for years, I would have tailor-made suits, Italian loafers, very nice ties.
When you're
And
managing
then,
big funds or big portfolios.
yeah, and I did all that, and I did it well. But my mom came down with Lou Gehrig's, so sister and I took care of her. Kim took care of all the physical needs, and I would just help move her and read to her and do whatever. But during that time, I also started back in a hospital taking some call, giving me a little something to do. I was thinking about going back to med school, and got used to wearing scrubs all the time. I mean, you got to love a job where you wear your pajamas all the time. And then I moved to the beach, which, is a little Jimmy Buffett kind of vibe. So, and I've gotten old and just to where I don't give a damn anymore. I'm not seeking promotions. I worry about what I do with the kids. What do I teach them? How do I communicate to them? And that's what I'm concerned with, not so much, my fashion choices. I like simple. I do take, bath or shower every day, so that's not a problem. But other than that, I am not a huge fashion maven.
Yeah,
And
he's
I
got
make no
like
apologies.
25 black t-shirts, 5 pairs of shorts, 5 pairs of jeans, a pair of khakis, maybe 2 nice pair of pants, and that's about it.
Yeah, I don't even have a suit that fits me anymore. The ones I did have were getting a lot of dust on them, and, obviously the styles have changed and cut, so I just threw them all out.
You threw them out?
Yeah.
The styles will come back.
Well,
You should
there was a sense there they were never gonna be worn again.
you should have saved them and sold them for mucho dinero whenever
Nobody's gonna
they come
buy
back.
old used suit, whatever.
What? Okay.
So,
We can agree to disagree on that one.
yeah. I'm glad you haven't given up bathing. There's a lot to be said for a simple life. I do maintain some basic standards of decency and cleanliness. Fashion, not so much. So I am consistently the most underdressed person at any gathering.
Mm.
So if you need somebody to make the bride look good, invite me to your wedding.
It's funny because our first date we went on, you were wearing a sport coat, shirt, nice slacks, loafers.
Created a
second
false
date-
impression.
Yes, you did. Our second date, he asked me to a concert, and I wear like just this black dress and flats. And he comes to the door in his black t-shirt, his khaki shorts, and his flip-flops. And he's like, "Hey," I'm like, "I'm overdressed." Okay. Yeah.
What's the old ZZ Top song? Sharp Dressed Man. Chicks
Every
love a
girl's
sharp dressed
crazy.
man. Every girl's
Every girl's
crazy about a
crazy
sharp
about a
dressed man.
sharp-dressed man.
Yeah.
If lyrics, I got it.
Yep. So
At least I made you wait 7 months for you to pull out
something
your
like that.
shorts and t-shirt.
Yeah, we went out once and then she ghosted me for 7 months. No lie.
So he
That's not
decided to
an
really impress
exaggeration.
me with his fashion conscience or his fashion sense on the second date.
Yeah, I figure I overdressed so much I scared you. So I thought I'd tone it down the second date.
Okay.
But yeah, I'd text her, call her, whatever. I wouldn't hear anything, and then, wait a few weeks. I'd send her another text, and she might reply, and it would be a nice reply. It wasn't like, get lost, you're bothering me or whatever. It's like, I can't go this time. Maybe, maybe next time, kind of thing. So she wasn't necessarily trying to get rid of me. I never got that vibe. It was just like, there's something else going on. It's not a good time. I don't know. So I'll try again in a month. And so I would maintain some distant but polite contact, never sensing that, I was making her feel weird. And called her up
And now
one
we're-
afternoon.
Mm-hmm. Go ahead.
Called her up one afternoon, said I had tickets to this concert, and wondered if she wanted to go. She said yes. So that was it.
And now we're best friends who live together. However that happens. I don't know.
However that happens.
Mm-hmm.
She's a very, very sweet spirit, a great person.
As are you.
So
And we tolerate each
All right.
other.
Anybody have any questions?
Even though he still tries to auction me off.
Hey, show me the money.
What do you get, a dowry for me or what?
That actually was one of the first things I asked you, is what your dowry was.
Mm-hmm.
Do you remember that?
Yes, I do. When I said I don't have any, so get over it.
I saw ZZ in concert ages ago, well before they released Sharp Dressed Man. That was a while ago. They followed George
Thorogood. I love him.
I love me some George Thorogood and
Mhm.
ZZ Top. I actually saw
Yep.
George Thorogood live
Did you
when
really?
I first moved here. Yeah, he was at, what's the place in Myrtle Beach?
House of Blues.
House of Blues in Myrtle Beach, and was a great night. ZZ Top I have seen live in concert, but it was after Sharp Dressed Man. But yeah, I'm a huge fan of their video. She's Got Legs.
Oh, that was
The
Robert
part-
Plant. No?
No,
Okay.
no, where they've got the white fuzzy guitars and spin them. I don't know why. I just think that's the coolest thing.
I remember that.
Yeah. The rhythm to the music, just the I don't know. It's just,
I remember
like,
that now.
yeah, that's just a great part of the video. Catherine, I think you two are sweet together. There's a lovely friendship between you. That's kind of you to say, but honestly, the truth is really quite simple. She would look sweet with Frankenstein. So I just am here taking up space.
No, we just care about each other's well-being.
Yep, we do. She's got a great heart, and
So
I'm
does he.
privileged to know her and be her friend.
Oh, same.
All right. Well, I don't think there are any other questions, comments.
Is anybody here? You got any questions, Frank?
Obviously, it's a little bit thinner crowd.
I know Catherine's here. Thank you, Catherine. I think everybody ran to my uncle. That's usually what happens when we have a thin crowd and Runkle decides to darn stream on a Saturday. Turd.
Runkle or Law and Lumber. So
yeah.
Runkle or Law and Lumber, because a lot of our people came over from a mention on Rob's channel. So, Catherine, appreciate you
Good
coming.
night, Catherine.
Good to see you. Good night to you.
Sweet dreams, my love.
Blessings to you. Our time is up.
All right.
We thank you for yours. Hope y'all have a good night. For those on the replay crew, we still love you. But we're going to talk to you about this Runkle thing.
Yeah. If you were at Runkle's, we're going to have some issues.
Y'all take care of yourselves. Have a great week. Thank you.
Good night.